Welcome to the deep dive.
Great to be here.
We've got this stack of sources. You shared all the articles, research notes, really focused on understanding the market landscape right now. And our mission really is to, dive into that material, pull out the most important bits, and give you a kind of shortcut.
Yeah, a way to get informed without drowning in all the detail.
Exactly. So you're not feeling completely swamped.
And we're not just, listing facts. We're trying to connect the dots here. We'll look at the big global economy picture.
Right.
Zoom into places like the U.S. and the Eurozone, see what the data says about stocks, bonds.
And even some broader themes like climate.
Yeah, climate impacts, long-term investing ideas. But, and this is key, it's all based only on the material you gave us.
Okay, good. So let's get started. We're probably going to unpack some surprising things, insights pulled straight from that data. Let's dive in.
Let's do it.
Okay, maybe we can start by just setting the stage globally. Looking at the big picture from these sources, what's the main takeaway on global growth?
Well, the sources, they lay out the consensus forecasts for real GDP growth for 24 and 25. And it's a bit of a mixed bag globally.
Okay.
You got the U.S. looking at maybe, say, 2.5% growth this year, slowing a touch next year. But then the Eurozone, the U.K., much slower, under 1% forecast for 2024.
Wow, okay.
They might pick up a little in 2025, potentially. Meanwhile, China's expected to keep growing faster, though maybe slowing down a bit too. So the overall story, moderate growth, but, pretty big differences depending on where you look.
Right, significant regional differences. And how does that translate to, business sentiment? Do the surveys match those forecasts?
They generally do, yeah.
Yeah.
If you look at the Global Purchasing Managers Index, the PMI, for manufacturing.
That's the one where over 50 is expansion, under 50 is contraction.
Exactly. And it paints a similar varied picture. Through May 2025, the Eurozone PMI, still below 50, so contraction in manufacturing there.
Okay.
The overall developed market index is kind of hovering just under 50.
Yeah.
Emerging markets are slightly above. And then individually, the U.S. and U.K. manufacturing PMIs, they're showing expansion over 50. Eurozone still below. Japan's right around that 50 mark. And China's is also above 50. So it really backs up that divergence we see in the GDP numbers.
All right, so manufacturing is definitely not singing the same tune everywhere. Let's shift to inflation.
Right.
What are the sources saying about prices?
Well, they give us the headline inflation numbers for the big regions, Eurozone, U.S., U.K., Japan, China. But what's also interesting is looking behind those numbers.
Like the input costs.
Yeah, the PMI input price index levels, for example, they show how much companies' costs are going up. Levels way above 50 suggest maybe more price pressure coming.
And are they high?
We see relatively high levels in the U.S., Eurozone, U.K., so cost pressures haven't completely vanished. And the sources also throw in wage growth measures for those places, which is, of course, another big driver.
So keeping an eye on both prices and the costs pushing them, how are the central banks reacting to this mix of growth and kind of sticky inflation?
The sources show what the market expects policy rates to do in the U.S., Eurozone, U.K., Japan. Generally, people are betting on some rate cuts. But the timing, how many cuts, it varies a lot by region. Suggests different levels of confidence about inflation getting back to target or about growth holding up.
Right.
And tied to that, there's a chart on global financial conditions. Gives you a feel for whether lending is getting tighter or easier overall. Big influence from central banks there and market mode.
And beyond the central banks, governments obviously have a big role. What about fiscal policy, debt levels?
Yeah, the data definitely highlights government debt as a percentage of GDP.
Yeah.
You can see the high levels, especially post-pandemic for the U.S. and Eurozone.
Still high.
Still high. And it looks at trends in government investment, too, which matters because, high debt can limit future spending while government investment could boost future growth. It's a balancing act.
Okay. And one last piece on the global stage of the consumer. How are households doing?
The sources give us a look at consumer balance sheets. We see household debt relative to GDP across regions. Shows how much leverage people have.
And savings. I remember hearing a lot about excess savings.
Right, and there's data on that too. Excess savings compared to before the pandemic for places like the U.S., Eurozone, U.K. It shows maybe how much of that cushion is left or, how much has been spent down. That impacts future spending power.
Okay, that's a really helpful global overview. So moderate but uneven growth, inflation pressures lingering but varying, central banks thinking about easing but cautious, and mixed signals on government debt and consumer savings. Let's take that and zoom in. Starting with the U.S., what's the specific story there from the data?
Right, the U.S. Well, the sources make it pretty clear. Consumption is king. It's consistently the biggest chunk contributing to real GDP growth.
No surprise there, maybe.
Maybe not, but the data confirms it strongly. And the business surveys, like the manufacturing and services PMIs, they're both showing expansion over 50, supports that relatively better growth outlook compared to, say, Europe.
So the consumer is key. How are they feeling? And is that showing up in spending?
Well, the sources track the U.S. Consumer Confidence Index, gives you that sentiment pulse. And the data also breaks down consumption by income group.
Oh, interesting.
Yeah, so you can see who's doing the spending. And there's this concept, the marginal propensity to consume, basically how much of an extra dollar someone earns gets spent versus saved. It differs by income and helps explain, whose spending is really driving things.
Which connects right to the job market, I assume.
Absolutely. Sources cover the U.S. labor market, unemployment, wage growth, the non-farm payroll numbers. The picture is, well, it's eased off a bit from being super tight, but it's still pretty strong.
Which helps consumers, but maybe fuels wage pressure.
Exactly. Supports income and spending, but, feeds into that wage component of inflation.
Let's talk U.S. inflation then. The sources break it down quite a bit.
They do. You can see the different pieces: energy, food, and then the core parts. Core goods, core services, excluding shelter, and shelter itself, which is basically rent.
And what's the main story in that breakdown?
The big thing is the difference between goods and services. Goods prices cooled off a lot for a while. But services prices, especially things tied to labor cost and rent, they've been much, much stickier.
Right, the sticky inflation everyone talks about.
That's it. And that stickiness in services is really central to the whole U.S. inflation picture right now.
And has huge implications for the Fed, I'd imagine.
Oh, absolutely. The sources show the current Fed funds rate, what the market thinks will happen next, and the Fed's own long-run ideas. Markets are pricing in cuts.
But the Fed might be hesitant because of that services inflation.
That's the tension. Exactly. That stickiness is a huge factor for their actual decisions. And the charts also show 30-year fixed mortgage rates, which are, a big deal for housing and very sensitive to Fed expectations.
Okay, shifting to the U.S. government's finances, what's the fiscal situation look like in the sources?
So you break down the federal deficit. You see the primary deficit spending minus revenue before interest payments, and then the rising cost of net interest itself.
Because rates are higher and debt is bigger?
Precisely. And the data points to future pressures, too, like the potential impact when parts of the TCJA tax cuts expire that's based on the analysis in the sources.
Oh.
You also see projections for federal debt as a percentage of GDP still heading upwards.
Any detail on spending plans?
Yeah, there's a look at the proposed 2025 budget showing where the money's planned to go and where it's expected to come from. Gives you a sense of priorities.
And with those higher rates, how are U.S. households coping with debt costs?
That's an important angle the sources cover. They show personal interest payments as a share of disposable income. How much income is just servicing debt?
And is that rising?
The trend shows it has increased, yeah. And it also breaks down debt that's in arrears late payments by type. Mortgages, credit cards, auto loans, student loans. Helps you see where the stress points might be building.
Now, something a bit different. The sources mentioned U.S. trade policy.
Yeah, kind of interesting. There's a chart with a U.S. trade policy uncertainty index basically tracks mentions in the news. And it also shows the U.S. effective tariff rate over time. And it includes references to potential future changes linked to campaign promises and end March announcements. The sources just present these neutrally as things that could change tariffs in the future. Highlights that trade policy is still, a source of potential uncertainty.
Got it. And lastly, for the U.S., demographics.
Data on population growth contributions from births, deaths, and net immigration, plus forecasts. And it shows trends in encounters at the southwest border. Its context for, future labor force growth, demographic shifts, things with long-term economic consequences.
That's a really thorough picture of the U.S. economy based on these sources. Let's hop across the Atlantic. The Eurozone, what's the main story there?
Well, similar data structure, the sources break down GDP contributions. But unlike the U.S., the Eurozone manufacturing and services PMIs are shown below 50.
Both. So contraction in both sectors overall.
Yeah, indicated contraction overall, which fits with those slower growth forecasts we talked about earlier.
So business activity definitely seems softer. What about investment?
Sources look at real investment trends, investment confidence, also data on loan growth for companies and households. Confidence has been, up and down, but loan growth has slowed down quite a bit compared to recent years.
Which could hold back investment and spending.
Yeah, it can constrain both.
And the Eurozone consumer, how are they feeling?
Data shows retail sales trends have been pretty weak. And consumer confidence, while it's ticked up a bit, is still way more subdued than in the U.S., suggests a more cautious consumer.
Okay. What's the job market like over there?
Sources cover unemployment and wage growth. Unemployment's been relatively low, actually. Wage growth was high, but there are signs that might be moderating in some data. What's really interesting, though, is the breakdown of unemployment rates within the Eurozone. France, Germany, Italy, Spain. Big differences between countries, which is important for understanding the dynamics inside the zone itself.
Right, it's not monolithic. How about Eurozone inflation?
Again, a detailed breakdown: food, energy, core goods, core services. Similar to the U.S. in that core services have been sticky, but the level on the path have been different. Sources compare headline and core against the ECB's 2% target, showing progress, but, still working towards it.
And how's the ECB, the European Central Bank, reacting to their inflation picture and the softer growth?
Well, the market expectations shown in the sources suggest people expect more aggressive rate cuts from the ECB compared to the Fed.
Ah, okay. Reflecting the weaker growth, maybe.
Yeah, weaker growth, different inflation dynamics. And the sources also show data on accumulated savings in the Eurozone since 2020, highlighting how much is just sitting in cash versus other assets could influence future spending.
Energy has been such a huge story for Europe. What do the sources show?
Oh, absolutely critical. The data starkly shows the shift in EU natural gas imports. You see the dramatic drop in Russian pipeline gas,
Replaced by
a big jump in LNG, especially from the U.S., and more from Norway. And it compares U.S. and European gas prices, shows how exposed Europe was to those supply shocks and price swings. Big impact on their economy and inflation.
And finally, for the Eurozone, defense spending.
Yes, the data looks at defense spending as a share of GDP for European NATO members. Shows the levels before and after the war in Ukraine. Highlights that push towards the 2% NATO target for many countries. It also tracks defense spending relative to other government spending over time, showing it's become a higher priority compared to decades past.
So beyond the U.S. and Eurozone, the sources also give quick looks elsewhere.
Right. There's material on the U.K. challenges with growth, inflation, fiscal stuff, China growth drivers, debt issues, especially property, the consumer there.
Yeah.
Emerging market structural changes, shifting trade patterns, like, China's changing share of U.S. imports. We can't dive deep into every chart, obviously, but these snapshots provide that broader global context.
That's a massive amount of economic background.
Yeah.
Let's pivot now. How does all this economic stuff translate into the investment world? Equities first. What about stock market valuations globally and regionally?
Okay, globally, the sources use the MSCI World Forward PE ratio price versus expected earnings. It shows it's trading above its long-term average right now.
So stocks look a bit expensive globally.
Suggests valuations are somewhat elevated, yeah. The sources also compare equity yields, dividends, plus buybacks to bond yields, like BBB credit. Gives you a relative income perspective.
And how do regions compare on valuation?
Sources give PE ratios for the U.S., Europe, ex-UK, UK, EM, China. What's really useful is the relative comparison. Shows the discounts or premiums versus the U.S. market.
And the U.S. is usually at a premium.
Yeah, the data shows the U.S. market has historically traded at a premium and still does. Places like Europe, the UK, tend to trade at a discount. Understanding that relative picture is pretty key for thinking about where to invest globally.
Valuations depend on earnings. What's the earnings picture look like?
Sources show trends in earnings per share, profit margins for the big regions, gives you a sense of corporate health, and crucially, they have the consensus earnings growth expectations for 24 and 25.
Market forecasts.
Market forecasts, exactly. And watching earnings revision ratios, whether analysts are bumping forecasts up or down, that's a key sign of momentum.
Looking inside the market, are certain types of stocks or sectors dominating?
Yes. The sources break down sector weights by region and show growth versus value sector weights for the MSCI world. Highlights things like, the huge weight of tech and growth stocks in the U.S. compared to other places.
What about income from stocks, dividends, buybacks?
Data on both. Buyback yields, companies buying their own shares, are shown across regions. That's a big deal, especially in the U.S. for returning cash. And dividend payout ratios, too, what slice of earnings gets paid out as dividends.
Anything on specific market factors, like quality or growth versus value?
Yeah, touches on those. Relative performance of quality stocks, strong balance sheets, stable earnings, and the valuation gap between growth and value indices. Historically, the sources also show characteristics of past bull and bear markets, how long they lasted, how big the moves were. Useful context. And data on small caps versus large caps, too. Relative performance, valuations by region. Shows how smaller companies can trade differently.
Let's drill down on the U.S. equity market again. Sources seem to have a lot there.
They really do. S&P 500 earnings estimates alongside the index performance, earnings growth trends. A breakdown of S&P 500 revenues by region shows how much big U.S. companies depend on overseas sales.
And valuations within the U.S.
Key U.S. valuation metrics compared to history forward PE, the Shiller-KP ratio, price to book. And this is striking. The sources show the forward PE for just the top 10 biggest stocks in the S&P 500 versus the rest of the index.
Highlighting that concentration issue.
Exactly. Shows how expensive and dominant those few huge companies are.
Okay, now, this seemed really critical in the sources for anyone thinking long-term about U.S. stocks. The data connecting starting valuations to what happened next. What's that show?
Yeah, this chart is, well, it's fundamental. It plots the S&P 500's forward PE ratio at different times in the past against the actual returns investors got over the next year, and more importantly, the next 10 years, annualized.
And the relationship.
The history shows a clear negative link, especially over 10 years. Higher starting PE ratios have generally led to lower subsequent long-term returns. Now, obviously, past performance isn't a guarantee.
Sure.
But this data, directly from the sources, gives you a powerful historical perspective. The price you pay today has historically mattered a lot for your potential long-term returns.
That really is a core takeaway. Okay, let's switch gears to fixed income, bonds. What do the sources tell us there?
They detail yields across a whole range of fixed income, say government bonds, investment-grade corporate debt, riskier high-yield bonds, emerging market debt. Gives you a snapshot of the income potential right now. They also show just how huge and varied the global bond market is by sector, by country. Much bigger and more diverse than equities in some ways.
And similar to equities, is there a link between starting yields and future returns?
Yes. The sources show government bond yields and the subsequent 5-year returns. Historically, starting yield has been a pretty decent predictor of future bond returns.
Okay.
And there's this helpful concept illustrated called the yield cushion. It shows how much yields can actually rise before the price drop wipes out the income you're getting. Quantifies the buffer your current yield provides against rising rates.
That's useful. What about yield curves?
Sources chart the 10-year government bond yields, nominal and real, so adjusted for inflation for major regions, shows how yields have moved. They also focus on the U.S. yield curve, shape the gap between long and short rates, and the U.S. 10-year term premium.
What's the term premium again?
It's basically the extra yield investors demand just for the risk of holding a bond for 10 years instead of constantly rolling over short-term ones. These things are key signals about market expectations for rates and growth.
And within fixed income, what about credit risk, like corporate bonds?
Sources cover credit spreads, that extra yield you get for taking on the risk of companies or emerging markets defaulting compared to safer government bonds.
And those spreads widen in bad times.
Generally, yeah. They widen when investors get nervous. The data shows spreads for investment grade, high yield. EM debt gives you a feel for risk appetite. The sources also dig into high yield fundamentals, default rates, the mix of credit ratings within high yield, shows the health or risk of that market segment, and of course, historical returns across different types of bonds over time.
We've hit the economy, the main markets. Let's broaden out to some other themes and those investing principles highlighted in the sources. What about commodities like oil?
Yeah, the sources have data on WTI crude prices and the U.S. rig count, which is a clue about future U.S. production. They also break down global oil production by country, shows who the big players are, how concentrated supply is.
The sources also had quite a bit on ESG themes, especially climate change. What stood out there?
That section was really packed with data connecting climate and economics. For instance, it quantifies the estimated hit to food inflation from specific events, like the 2022 summer heat wave in Europe.
Wow, a direct link.
A direct link. It also looks at carbon pricing efforts globally, what share of emissions are covered, what the prices are, comparing them to benchmarks like what the IMF suggests for 2030. And you see CO2 emissions by country and per person. Shows where the hotspots are.
And how do different sectors and energy sources play into that?
Sources detail energy use by sector, transport, industry, and projections. And these show greenhouse gas emissions by economic sector, identifies the biggest sources, like energy and transport.
What about solutions? Investment.
Data on global investment in climate mitigation and adaptation, renewables, grids, storage. But it also starkly highlights the adaptation financing gap for developing countries. Current investment is way below what's estimated to be needed. And the data on electric vehicle sales and market share is fascinating, especially when you see the chart comparing the mineral content of an EV versus a regular car. Huge difference in what metals are needed.
Right. Highlights the supply chain shifts. It
Yeah.
really shows how tied together climate, economics, and markets are. What else was in that investing principles section?
This last part is full of, well, timeless stuff shown through data. Life expectancy probabilities fundamental for long-term planning, retirement.
Yeah.
And the sources illustrate the power of compounding just beautifully. Examples showing how reinvesting income, investing consistently over time, leads to massive growth compared to just the initial investment.
And the flip side, holding cash.
Exactly.
Right.
The sources show the impact of just holding cash, the tiny income you might earn, versus how inflation eats away at its actual buying power over time. A really strong visual reminder that cash isn't truly safe from losing value.
And the long-term history of asset returns.
Absolutely powerful. The chart showing how $1 invested decades ago grew in real terms, in stocks, bonds, cash, clearly shows equities historically winning out over the very long run. Explains why they're usually core to growth portfolios.
There was also a chart about handling market drops during the year. That seemed important.
Yes, that one's crucial for keeping perspective. Uses historical data, maybe MSCI Europe, showing that even in years with big intra-year drawdowns, 10%, 20%, sometimes more, the final annual return often ends up positive.
So don't panic about the volatility.
It's a visual lesson in that, yeah. Shows how normal big swings within a year are, and why focusing only on the short-term noise can be misleading for long-term results. The sources also plot that classic risk versus return trade-off for different assets. Higher potential returns have historically come with more bumps along the way. And there's an interesting chart on fund flows, mutual funds, ETFs versus the S&P 500. Notes a tendency sometimes for retail investors to sell near the bottom. Behavioral finance in action.
And finally, performance after shocks and the benefit of time.
Right. Analysis of how a balanced portfolio did after major economic or geopolitical shocks often shows resilience, positive returns over the next 1-3 years compared to cash, and maybe the most important chart for long-term folks. The range of U.S. asset returns, stocks, bonds, balanced based on how long you held them.
What does that show?
It powerfully shows that longer holding periods, 5, 10, 20 years, historically narrowed the range of outcomes dramatically. Reduce the impact of short-term swings, increase the odds of a positive return, really drives home the benefit of time in the market. And sources show similar data in euros too.
So, wrapping this all up, what does it all mean? We've gone through a lot here. A real deep dive into these sources, covered the global economy, regional specifics, stocks, bonds, climate themes, investing principles.
Yeah, we really tried to connect those dots, cut through the noise of all the data, pull out the key insights, and give you a clearer picture based only on what was in that material. Showing the trends, the relationships, some of those may be enduring market lessons.
So as you, our listener, reflect on everything we've unpacked today, from, sticky U.S. inflation and Europe's energy pivot to that link between starting valuations and future returns, the mineral needs for green tech, or just the simple power of compounding and holding on, what single piece of data or maybe a connection between themes stands out most to you? What's something worth chewing on a bit more as you think about this market landscape?